Right, great. Thanks, everyone. Thanks for joining us. And appreciate everyone signing in on what is, in Canberra at least, a freezing cold winter day. We're very lucky to have Griffith University Professor of Economics, Tony Makin, here with us. Tony's an author of over a dozen books, academic conference papers, journal articles, and is one of Australia's foremost experts on public finance, fiscal policy, and macroeconomics. We were very lucky to get Professor Makin to talk to the ACT Young Economists out of the Economic Society of Australia today, given his 2018 book, The Limits of Fiscal Policy, is now emerging as a very prescient text given the circumstances we find ourselves in. I won't waste too much time with introductions. I might hand over to Professor Makin. Tony, thanks very much.
Good. Hello, everybody. And let me start by thanking Lachlan and the Young Economist Group from the ACT branch of the Economic Society, and also to Di for her technical assistance, making sure this is going to work okay. And I hope it is. Last time I spoke to the ACT branch of the Economic Society was at the outbreak of the global financial crisis. That's well over a decade ago now. And am today speaking on the same broad theme, that is fiscal policy and how it works and how it doesn't work. So the GFC, in fact, inspired the book that Lachlan asked me to speak about, The Limits of Fiscal Policy. So I'm going to talk about the contents of the book, although a few days ago when I started thinking about what to say, I realised that there's too much in the book to cover, so I'll be very selective, but time permitting, I'd also like to say a bit about the relevance of aspects of the book to the current COVID-19 crisis. So I'll say a little bit about that and the legacy that's going to leave and the response to it. So I've asked Lachlan just before to cut me off if I go for too long, because I'd like to allow a little bit of time for questions. So I'm now going to go through a bit of a slideshow because I want to do some analysis, show you some analysis that is in the book, and we need some pictures for that purpose. So the book's called The Limits of Fiscal Policy, and that's what it looks like. And that's the contents of the book. So just briefly talking about each chapter, the first one talks about the Keynesian Revival, and I think it was extraordinary. As somebody who's been a macroeconomist for many years now, the resurgence of fiscal activism as a policy tool at the time of the GFC. Prior to that, the monetarist and new classical approaches had basically argued that fiscal policy was best left as an inert instrument, that it shouldn't be used actively as a demand management tool, that it was best to leave that to monetary policy, and fiscal setting should be for the medium term. So it did come as a bit of a shock to me as a former IMF economist as well, how the IMF completely steered the ship around in a different direction than it had hitherto been travelling. So the book looks at different approaches to the budget accounts and the use of fiscal policies. So the first chapter, as I said, is about the Keynesian Revival, the introductory chapter. The second chapter sets the accounting foundations, and I call them macro foundations. And as many would be aware, studying that micro foundations have been the rage for quite a while, since the new classical paradigm began to hold sway. Well, I think we should go back to basics and look at macro foundations, which is indeed the way that Keynes presented his work on the basis of aggregates. So I set those foundations with reference to funds flows and monetary aggregates in chapter 2, just to set up some basic tools for application in subsequent chapters. Chapter 3, I use an extended loanable funds framework to think about the consequences of budget deficits in an open economy in particular, though I do contrast with closed economy cases and talking of crowding out. Chapter 4 extends that analysis by thinking about the income effects of those forms of crowding out. They have real income effects. So if you're crowding out investment, obviously you've got lower capital stock and you've got less production. So there's a real cost in terms of national income. So chapter 4 is about that, an extension really of chapter 3. Chapter 5 is in the vein of Mundell-Fleming analysis. It's a little bit different. It's got incorporates more variables into the model and the classic approach, but it gives the exchange rate a main role in how fiscal policy works. And then following on from that, chapter 6 is a framework that also has the exchange rate at the centre of analysis. And this is in the tradition of the dependent economy approach to macroeconomic analysis. We go back to ANU economists, in fact, Trevor Swan and William Salter, who developed the so-called dependent economy model, which has gone into a bit of disuse in recent years, but I think it has some powerful insights. And I'm going to highlight that model in what follows. Then chapter 7 talks about fiscal consolidation, that is repairing the budget, and what that does to the economy. And then obviously it's going to be the reverse of what's been said prior, because most of what's been said prior has looked at the impact of government spending. So it's more about government spending than revenue in the analysis. It's all about boosts to big G, if you like, rather than changes in big T, although they are canvassed briefly, the tax implications along the way. And then lastly, chapter 8 is talking about what fiscal policy should seek to achieve and what its targets should be. So, as I said, it's a non-Keynesian approach to the economy, although you could argue that the Mundell-Fleming model has very much Keynesian underpinnings, but it doesn't give you Keynesian results. But just start off here with a couple of quotes about how Keynesianism was viewed at the end of the 1930s when it had been in operation, and also at the end of the 1970s when it had another resurgence. And Morgenthau, the US Treasury Secretary there, said, we're spending more than we ever have spent before, and it does not work. After 8 years of this administration, that was FDR's administration, we have just as much unemployment as when we started and an enormous debt to boot. James Callaghan, the Labor Prime Minister of the UK, said in 1977, we used to think we could spend our way out of recession. I tell you in all candor that option no longer exists, and if it ever did exist, it only worked by injecting bigger doses of inflation into the economy, followed by higher levels of unemployment as the next step. That's the history of the past 20 years. So we saw at the GFC, as I said a minute ago, the Keynesian Revival, where fiscal policy was swung into action as a crisis management tool. But at the time, there was a reaction from a host of very reputable US macroeconomists, John Taylor, Makin, the list goes on, who signed a letter saying that to think that government spending will counter recession was a triumph of hope over experience. And they boldly stated that more government spending by Presidents Hoover and Roosevelt, did not pull the US economy out of the Great Depression. So there's still a debate about how much the Keynesian policies worked during the Great Depression. So just one more quote before I launch into the analysis as such. And it's a quote I chanced upon right back when I was doing my honours thesis many years ago, as it turned out, on the exchange rate. And an economist, Hubert Henderson, wrote a nice article about the exchange rate in the UK context. And he had this to say that nothing has done more, in my opinion, to lead modern economics astray than the practice which Lord Keynes brought into fashion in the 1930s of reasoning on the hypothesis of a closed economy. And those who've read the general theory will attest to that. There's no exports, import, capital flows, exchange rates, or public debt in the general theory. It's a closed economy framework. It is paradoxical that British economists should have led this intellectual fashion at which Adam Smith, David Ricardo, John Stuart Mill, Bagehot and Alfred Marshall would certainly have knit their brows. So let's just look again at what you learned in first year economics. That is the Keynesian Cross. And I think that's at the heart of Keynesian analysis, what I'd call crude Keynesianism. And we have the 45-degree diagram, we have expenditure on the vertical axis, and we have output and income on the horizontal axis. And we know from our first year that the equilibrium is determined at the point of intersection on that 45-degree line. Okay, so this is a device that was actually invented by Paul Samuelson, a leading Keynesian macroeconomist, US macroeconomist, who popularized Keynesian thinking in his famous textbook. So there we see that other things the same. You increase government spending, lo and behold, you get an increase in income and output. So the implicit assumptions there is that the economy is at less than full employment, the price level's fixed, and importantly, there's no money or funds there at all. So that's the result you get. Strictly demand-driven national income determination. And of course, you can get a multiplier if delta Y exceeds delta G by definition. So problems with that, and as students learn when they progress through their undergraduate studies, is that once you bring ISLM into the picture, and you, as Sir John Hicks suggested, you bring the monetary side in, then you get slightly different results. And in fact, as Friedman said, if you've got a vertical LM curve, it doesn't work. You just get full crowding out of investment as a consequence of an increase in government spending. And that's, of course, in a closed economy. If you open the economy up and you introduce capital flows and exchange rates, the textbook Mundell-Fleming model, which all students should be learning in undergrad studies, shows that fiscal activism under a floating exchange rate causes a crowding out of net exports. Yeah. So I'll come back to that shortly, but most economies now have floating exchange rate, Australia included. And we'll show that the lessons of that model were or should have been learnt as a consequence of the GFC. Australia provided I would think, almost perfect case study of the application of the Mundell-Fleming model. Another offset that occurs is through Ricardian equivalence. So private saving, according to Ricardo, who didn't have his heart fully in his proposition, but he said that households will save as a consequence of an increase in public debt, and hence that will mean lower consumption because the saving is to accumulate funds to pay future taxes to pay off the debt. Okay, that's a Ricardian equivalence. So we're going to see in a minute that you can show those counter theories or counter Keynesian theories with reference to the Keynesian cross. The multiplier also is central to Keynesian analysis, and it depends critically on the consumption function being a Keynesian consumption function that is dependent on current income. But once you bring in permanent income, as Friedman did, it doesn't work. And then there's the practical issues of recognition of the lags that occur in policy making, recognising the problem, implementing the policy, and then the delay in the actual action. So here we have the Keynesian cross. We increase government spending, but each one of those counter theories suggests that that aggregate expenditure line comes back down again. Okay, so in ISLM, for instance, with a vertical LM curve, it's going to come back down because investment is offsetting the delta G. In loanable funds, the same story. The interest rate will go up in a closed economy, and the delta G will be offset by delta I. Mundell-Fleming suggests that the delta G will be offset by delta NX. And in Ricardian equivalence, the delta G will be offset by delta C, private consumption, as households save more. So that suite of alternative models all suggests that the simple crude Keynesian proposition that increased spending increases output is not true, okay? And if you think about the reasons for each of those offsets, it all has to do with introducing either funds or money, okay? Either funds or money. Once you introduce funds and money, you get the offset in some way or another. And so this is just an alternative depiction of what's going on there. If you increase the government spending, increases aggregate expenditure, you get, if starting from a budget balance, that's going to be equivalent to the budget deficit, but subsequently you're going to have a reversal due to either some investment crowding out or trade crowding out, right? And Ricardian equivalence, you'll also have consumption crowding out. Okay, so as I said, I can't cover everything that's in the book, but I do talk about those issues in an early chapter to set the to set up to the following contents of the book. But there's one model that I just want to highlight, and that's the model that's outlined in the chapter on the dependent economy approach. So the dependent economy approach is based on the dichotomy between tradables and non-tradables. Okay, so tradables are those goods and services that either directly enter into trade, international trade, or compete with international trade. So it could be domestic manufacturing that competes against imports. It could be wine consumed in Australia that could be exported. All those industries that are exposed in some way to international competition, versus non-tradables, which is everything else, but largely services, but also includes construction and a host of other industries that aren't really subject to international competition in any way. So this approach, as I've outlined in the book, has a supply side and a demand side. You just have an aggregate output of tradables and non-tradables, and you have expenditure on tradables and non-tradables. And as the economist Sidney Alexander, IMF economist, highlighted in his much neglected 1952 paper, the difference between what's spent in the economy and what's produced is actually the trade imbalance. Yeah. So I won't spend too much time on the underpinnings. There's monetary underpinnings and there's real sector underpinnings, but essentially we can set up this sort of framework, which is really just a supply and demand framework for both sectors. So in the left panel, we have the non-tradable sector. In the right panel, we have the tradable sector. And the equilibrating variable there is the real exchange rate, defined in the classic dependent economy way as the relative price of non-tradables to the price of tradables. So there we start off in equilibrium, and if we increase G and spending by government is on tradables, then obviously that's going to shift the demand for tradables. Everything else is the same. What does that do? It just increases the trade deficit. Yeah? So we go from assuming a balanced trade account at the initial point of equilibrium, just look at the left panel there, and we increase the demand for tradables, and that will shift the demand for tradable schedule to the right, but just manifest as a trade imbalance. Nothing's happening in the non-tradable sector. Now, governments don't do that. When they spend, they focus on non-tradables. And we're seeing that exactly now. The Queensland state government has announced a supplementary scheme to what the federal government's done with assistance for the construction industry, the home building industry, grants for homes, and that's in the non-tradable sector. Okay, so in fact, during the GFC, Treasury was saying that they're focusing on activities in the non-tradable sector. So what happens there in this model? Well, you increase the demand for non-tradables. Looking at the left panel here, that's going to appreciate the real exchange rate. Going to push up the price of non-tradables relative to tradables. And that's a loss of competitiveness because it's drawing resources away from the tradable sector. And you can see that in the right panel. The resources, because of this relative price change, the real exchange rate deterioration, means that there's a contraction of the supply of tradables and there's an increase in the demand for tradables. And of course, you're still going to get a trade deficit as a consequence of that loss of competitiveness. And that's exactly what we saw during and after the GFC. And in fact, for a long time, because government spending has been growing, that relative price has been rising, defined as the PN on PT, which means a loss of competitiveness. So let me just now track back to the GFC fiscal response, because it can, with reference to the data, illustrate how the response there was a case study in open economy macro analysis. Okay, so we know that the fiscal response to the GFC at the time was one of the biggest in the world, just as the COVID-19 fiscal response has been one of the biggest in the world. And we heard that the national accounts showed that we avoided recession, but that wasn't in fact true. If you look at, well, technically it was true if you just look at the aggregated national accounts measure, which weights expenditure, income and output. But here we see that there was a recession. When you just look at nominal GDP, when we look at real GDP on an income basis, there were 2 quarters there that showed recession. Real GDP on a production basis, there were 2 quarters there that showed recession. And on a per capita basis, which I think is the best way to think about whether you've got a recession or not, and admittedly we've had one on that basis for on occasion in recent years. So other measures showed that there was a recession. The one that didn't was the real GDP expenditure measure, which just managed to put the real GDP weighted average measure just over the line. But of course, unemployment went up and other indicators suggested that the economy was in pretty poor shape. So this chart now shows what happened to the exchange rate over this period. And we see that the exchange rate fell precipitously at the time of the crisis, September 2008. It then fell to a floor level and stayed at that level until the very day that the second stimulus package was announced. So if you look at the bottom of that exchange rate line, that was a day then the second stimulus package was announced. These bars are just the relative, the different GDP measures according to expenditure, income and production. So from this day, we see the exchange rate continuing to appreciate as the government spending was increased. What was happening in the national accounts on a disaggregated basis? Well, here we see the main story belonging to net exports as the main player. Yeah, net exports, that's this purple line, had been negative. There was a big drop in private investment at this point. Okay, this was the crisis. These were the critical periods, quarters, the September and December quarters. Exchange rate had depreciated and the net exports went up because China was still buying lots of commodities, but the exchange rate depreciation was so strong that it also curbed imports sharply, and net exports basically saved the day. It wasn't government spending, that didn't figure large there at all, right? And then we see that the stimulus was rolled out, the exchange rate appreciated. Ideally, I could have superimposed that exchange rate line on this chart as well, but you'd see that over this period was when the exchange rate started to appreciate, and the big change there was a swing back to a trade deficit. Okay, so that's just completely consistent with the Mundell-Fleming model. It's exactly what the Mundell-Fleming model says. It says that if you increase government spending, you put upward pressure on the exchange rate, and it crowds out net exports. I've also done some work with colleague prescient and looking at the relationship, the econometric relationship between government budget balances and the foreign borrowing or current account. And we showed that looking over the period from 1983 to 2009, that they were almost exactly twinned, which again is consistent with the Mundell-Fleming model and also with the dependent economy model I've just outlined. The government spending through the exchange rate will worsen competitiveness and impact on the trade account. Okay, so let me just now say a bit about it. I said what I had to say about the GFC. Now just say a bit about the COVID-19 response, which, as I said before, has been a massive response. The Office of Budget Management, I checked yesterday, is showing $2 billion a day being issued, public debt being issued, $2 billion a day. So there's this legacy of that. But let me just say a few words first about the response itself. I wouldn't argue against the necessity of the response. There had to be a macro response as a consequence of government mandated lockdown, and the monetary response, have no problem with that. It provided support for aggregate demand and supply in the economy. The investment incentives that were announced were also useful as a supply side and demand side measure. And the JobKeeper, which is really at the heart of the whole program, the wage subsidy element, I think provides a useful prototype for dealing with future black swan emergencies of this kind. In fact, far superior to the sort of GFC response where government just decides to spend in certain areas, irrespective of the skills in the industries where they start spending. I mean, if you're an unemployed beautician, you probably won't want to be working building school halls, just as an example. But the fact is it assumed that labour was unskilled, and if you just spend in one area of the economy, then labour will move to, unemployed labour will move automatically to that sector, okay? Which may well have been true in the 1930s when you had unemployed factory workers could work on public work, unskilled labour was more mobile. But many of the assumptions of the Keynesian model, including that one, don't hold today. So the fiscal response to the pandemic at both the federal and state governments, we should not forget what the state governments are doing in response. It's a massive exercise in increasing government spending and tax relief with implications for state debt. What we're going to see as a consequence of that is that the level of public debt, that's federal and state, is likely to double estimates of well over $1 trillion, even perhaps $1 trillion for the federal government alone. Okay, is that a problem? Is that a problem? Well, I've emphasised the importance of thinking about fiscal policy analysis in an open economy, and so we'll talk about that in a second. But the dynamics of having big deficits mean that you see governments borrowing $2 billion a day, increases in public debt. That debt has to be serviced, public debt interest, which then feeds back as an outlay item in the budget, which adds to the deficit. Okay, so that's likely to be the fastest growing item in years going forward. Because Australia is an open economy, the public debt is not owed to ourselves, a phrase I think coined by Abba Lerner, the American Keynesian economist, which again suggests the economy is closed. You owe it to yourself. The government raises the borrowing and incurs the debt, but then it's owed to the rest of the population, the residents of that economy. That is not true in Australia's case, because the federal and state governments mainly borrow from abroad. And again, if you look at data from the Office of Financial Management, you'll see that it varies between 60 to 80%. In fact, I'd suggest it might be, it could well be more than that on the latest data, to cover budget deficits, okay? So that's a different story. We're not owing it to ourselves, we're owing it to foreigners. And why is that a problem? Well, firstly, it is likely to jeopardise Australia's AAA credit rating, the loss of which will impact on interest rates right across the spectrum via a risk premium. It's hard to say what that would be. It's going to affect state government credit ratings as well. It usually filters down to state levels, given that the Commonwealth is effectively a guarantor of state debt, and it will impact through interest rates for business through the raisings that the banks undertake from overseas. Yeah. So if you've got $1 trillion of debt, every basis point, 0.01% in increase in the risk premium will mean another $100 million in public debt interest. Okay, so you're talking about opportunity cost here. That means there could be a small regional hospital, country town hospital, for every basis point, $100 million. And that public debt interest paid to foreigners is a net drain on national income. So if you look at the national accounts, what's paid abroad in interest is just subtracted from GDP to get national income. And at federal level alone, in recent years, that's been close to 4 times the size of Australia's foreign aid budget. So we're paying foreign bondholders who've lent money, not backed by government assets as such, because the Commonwealth Government's balance sheet reflects mainly consumption-related activities. So the public debt is deteriorating net worth, and the cost of the public debt interest is some 4 times already the size of what's paid in foreign aid. It's 3 times federal spend on higher education and many other government programs. It's bigger than the pharmaceutical benefit scheme cost, for instance. Third, we should be concerned about this is, well, no surprise, because of what we've just talked about. That is the Mundell-Fleming type approach, dependent economy type approach. The issue of these bonds will drive up the exchange and capital inflow, worsening competitiveness, which will harm the tradable sector. Right? So that, just, as we said before, with the GFC fiscal stimulus, the dollar surged and it reached up to $1.10 US, which led to the demise of parts of manufacturing, and I would hazard also saw the end of the motor vehicle industry, which couldn't compete internationally. So will higher national and global, Australia's not doing this alone, the amount of public debt issued by the United States government is staggering compared to what Australia's doing, given the size of the US economy and the fact that their response is comparable relative to GDP, along with a host of other advanced economies in Europe, massive issues of global public debt. So what does that mean? Well, evidence shows that, econometric evidence shows that it will impact on economic growth. And you've got the Japan example there. You've got Japan having to refinance its public debt every year, and the proportion of refinanced public debt is actually far higher than its annual borrowing requirements. Actually about 40% of GDP is refinanced public debt in Japan. So lower growth is one possibility. And the IMF's done some estimates on this as well, that for every 10 percentage points of public debt increase, it tends to decrease GDP by about 0.2%. Inflation, well, history shows that that is the consequence. So the great inflations have largely been generated by monetization of public debt, going back to Weimar Republic, Germany, more recently Venezuela, Zimbabwe. Monetizing public debt has historically been associated with high inflation. So it may be some combination of that, the high inflation or moderately high inflation, lower growth. We're back to the 1970s, experiencing a combination of those, the stagflation. And of course, there's also the argument about public debt being a burden for future generations, something that even Thomas Jefferson noted many, many years ago. Just check to see how I'm going for time here.
I think you've got about 5 more minutes or so, Tony.
Okay, good. Okay, good. Okay, so I'll just go through this fairly quickly. That is that if we keep spending, there's going to be some impact on growth as a consequence of being beyond what the optimal level of government spending is as a share of GDP. So in other work I've done with colleagues, Julian Pearce and Sharma Ratnasiri, we've looked at this question of what the optimal size of government is, and our work shows that it's beyond the optimal level. So I'm going to run out of time here, so I'll just skip over this. But this curve shows that if you get government spending as too big a share of GDP, then your growth level is less than it would be if the share of government was smaller. Okay, so there's quite a history of literature on that. Yeah, and that does not mean that if you wind back your share of government that you're going to necessarily have a lower score on the Human Development Index. In fact, there's a negative correlation between the size of government and the score on the UN's Human Development Index for advanced economies. Okay, so I'll just finish off with a few comments about the policy response, contemporary situation with COVID-19, and I'll refer you to a paper that I've written that's just been released by the Centre for Independent Studies this week, which advocates the need for addressing the legacy of this crisis, the fiscal response to it, by trimming government spending and some other measures. And interesting quote by Greenspan, that Alan Greenspan, the former Federal Reserve chair, who argued repeatedly that he thought that paying down national debt was beneficial for the economy. Keeps interest rates lower than otherwise, frees saving to finance increases in the capital stock, thereby boosting productivity and real incomes. And you can get that result out of the models that I outline in the book that I'm I'm talking about. So as a policy response, there's great scope for cutting government spending. If you look at the amount of industry assistance that's provided by the federal and state governments, and you look at the amount of overlap in spending at federal and state levels, particularly in the areas of health and education, there's great scope for a consolidation there. And also the need for tax reform, including to the company tax rate, which is now deterring foreign investment. And that's one reason why the current account is now in surplus in recent years pre-COVID. It's pretty sure to go back into deficit as a consequence of the budget deficits, but it had been reaching balance because investment has been falling. Yeah. So just to finish off, the last chapter of the book that I was asked to speak about, The Limits of Fiscal Policy, just argues that budgetary settings, fiscal settings, should have the following aims. They should ensure that public debt is sustainable, should have a medium-term role, be conducive to sustaining business and household confidence, encourage equity, productivity improvement, and private investment by the tax regime, and that infrastructure should be adequate, but should be put in place on the basis of cost-benefit criteria. And meanwhile, the book argues that, in conclusion, that fiscal consolidation can raise future national income if the level of spending is above the optimal level, and the best way to do that is to target overlaps and unproductive government spending. So thank you very much. Ready to take questions.
Terrific. Thanks very much, Tony. Absolutely fascinating stuff. I've started reading the book, and it's absolutely brilliant. Now there are a million questions. I've had a couple of audience questions. There are a million questions I could ask, but I'll contain myself. Ranging from why Japan's debt monetization over 30 years hasn't been inflationary, or say what the implications of recent comments from the RBA that banks essentially lend by creating credit out of thin air rather than by lending savings, what impact that has on the vulnerable funds theory, but there's probably nowhere near enough time for those questions. I'll quickly just ask you about your views about discretionary versus automatic fiscal policy. So one of the arguments that advocates of the employment buffer stock model or employer of last resort model use is actually quite sort of, and they'll never tell people like Bill Mitchell and Stephanie Kelton and others that I've said this, but there's almost sort of a fiscally conservative argument underlying this argument that you should try and put the budget on autopilot as much as possible to limit fiscal sort of meddling by politicians, because essentially the discretionary model, discretionary fiscal activism requires politicians to spend the right amount of money in the right places at the right time on the right people. And we know that there are all sorts of issues around corruption. Hayek pointed out that central planners don't have access to enough information. Even on the sort of the hard left, economists like Pavlina Chernova have said, well, if you want to achieve full employment via fiscal policy, why not just do it through the most direct, cheapest, least capital intensive way? And I had this debate with a new Keynesian colleague recently. He was saying the job guarantee is bullshit jobs. And I said, well, your alternative is bullshit infrastructure and building a bridge to nowhere in every remote Queensland town. And I know which one I'd prefer. So I can imagine your argument would probably be, you'd say neither. But if you absolutely had to choose between an automatic fiscal stabilizer to pursue full employment or discretionary fiscal activism, which would you choose?
Yes, good question, Lachlan. I would favour the automatic stabiliser, and I think there's the makings of a fiscal rule with JobKeeper. I think that's a far more direct way to help stem unemployment, is to go straight to the source and keep the employment going to the extent possible, as opposed to creating make-work projects elsewhere, which, as I said before, is not going to necessarily match the skills. Those who've lost their jobs in the banking industry are not going to be wanting to put pink bats in the ceiling, for instance. So that sort of old style Keynesianism, I think, is misplaced. But if you generally think about the importance of the supply side, I mean, the supply side is where the jobs, most of the jobs are created. It's the firms that create the jobs and employ people. So if you've got a crisis, then you can sort of target those firms directly, as JobKeeper has done. I think the wage subsidy idea is far superior to the alternative of just spend here, there and everywhere on the whim, as you say, on the whim of politicians. It could well be finessed, but as I've said, I think there's the makings of a fiscal rule there, which would be far more efficient than the sort of Keynesianism we've seen in the past.
Terrific, thanks. So Benjamin asks, how can we eliminate financial crowding out? Do we use monetary policy as well? Or I should say, can we eliminate financial crowding out?
Okay, well, if you take a strict open economy view of the world, as I tend to do, I mean, the crowding out, I think, is mostly going to be through net exports, yeah. But there will be crowding out indirectly if the credit rating is lost and we get interest rates rising. There'll be investment crowding out. There's also, I suspect, some investment crowding out due to Ricardian effects. That the Ricardian equivalence proposition was all about how households perceive future debt, but at the same time, firms are also concerned about high debt levels because it could mean higher company taxes, and that's going to be a disincentive to private investment. So there's probably not one single channel that crowding out occurs through, and I show in one of the chapters of my book, which I didn't cover it much at all, if you're looking at it from a loanable funds point of view, if you get the risk premium rising as a consequence of the external borrowing that's consequent upon the budget deficits, then you're going to get a combination of investment crowding out and net export crowding out. Could be both.
Kevin asks, regarding the Keynesian Cross, you stated that the increase in G during the GFC crowded out net exports in Australia just after the GFC. If this is the case, what's the empirical evidence to suggest that this happened?
Yeah, well, those charts that I showed, the national accounts, the raw data do show that, and that was published in an article in the online journal Agenda, which you can probably find, that just looked at the data and analysed that. But then the more formal empirical approach that my colleague Paresh Narayan actually did was looking at the econometrics looking at the relationship. Over the long term, we see that there has been a strong relationship there between increased budget deficits and trade and current account imbalances. So I would predict that we're likely to see that again. We're likely to see the current account go to deficit, which will be reflective of the budget deficits.
Sure. Stephen Bartos states, credit ratings are relative. This is sort of more of a statement rather than a question, but I'll let you respond to it. Credit ratings are relative, not absolute standards. So if Australia's debt increases, but other countries increases faster, our relative standing ought not to be affected negatively. How would you respond to that?
Well, it depends how the market responds. It's all up to the market. I mean, how the market responds in the bond markets will determine what the risk premium is. There will be surely less demand for Australian bonds, which other things are saying will push up interest rates. But the magnitude of the risk premium, it's hard to predict. It's something that the markets will determine. But as I said, each basis point, that's a very small amount, means $100 million extra public debt interest.
Okay, good. We had essentially the same question from Mill, so I might essentially answer that. So I'll just move on to the next question. In the face of these, this is an anonymous question. In the face of these types of black swan events, COVID, etc., how do you think governments should balance massive expenditures needed to preserve public safety against future costs? Is there an ethical standard to be used?
I'm not sure what trade-off you're thinking about there. Is it the trade-off between the benefit of saving lives versus the cost of it? Yeah.
I suspect so, yes.
Yeah. Well, I'd refer listeners to the National Economic Poll on this of the Economic Society. Just a short while back, it's on the Economic Society website. So, I mean, there's some debate about whether it is actually a trade-off. In my answer to that poll, I presume that there was a trade-off. And we see that in practice in other fields of the economy where the federal government actually values human life. So if you put a value on human life, you then have to estimate how many lives have been saved versus the cost of saving them. It's just an application of cost-benefit analysis. But look, I'd refer anyone who's interested in that particular topic, and it's a tricky one. There's so many unknowns about the modelling for the morbidity rate, the value of life by age cohort is tricky as well. But I would refer the questioner to that website.
Sure. Toby Chambers asks, there is a current mismatch with Treasury issuing large quantities of shorter dated bonds while the RBA buys longer dated debt. At some point, will this all blow up with a major reset of interest rates and bond prices when the RBA can no longer continue to be the buyer of last resort if its own balance sheet are at risk? And he notes, March 2020 bond markets froze up and there were no buyers until the central bank acted.
Yeah, look, something's got to give at some stage. And I mean, it's almost unprecedented, the extent of bond buying by the Reserve Bank, not only here, but in the UK and elsewhere, which, our textbooks tell us is just equivalent to monetisation. Okay, they might be buying in the secondary market as opposed to at the time of the issue of the bonds by the treasuries, but effectively it's going to have the same impact on money. And history shows that can be a real risk for inflation.
We've got another anonymous question here. If you could choose, you've sort of covered it to an extent in your presentation, but if you could choose one policy for the government to introduce as part of its COVID response, what would you choose and why?
Well, that's a tricky one. I mean, there's two responses. There's a response to the lockdown, okay, and then there's got to be the response to the response. There's got to be the response to the consequences of the lockdown. So the paper I showed there, the CIS paper, which I think you can download, it does evaluate the actual response, and I suggest that aspects of it were excessive. The supply side measures were warranted, but the demand side measures were not. Giving cash bonuses to pensioners who couldn't go out and spend was not sound economics in my view. But in terms of the JobKeeper, I've said that was a useful prototype. It's got its flaws, obviously, as we'll learn when the Treasury, if it releases its review of it this month and finesses it, it has its flaws. But as I said, that was probably not a bad policy innovation at all. In terms of the legacy and how to respond to the legacy, again, I suggest you read my CIS paper because I there emphasise the need to cut back on spending as the prime way to reduce the public debt.
Terrific. We've got I think we've got one last question, and I've got one that I can sort of tack onto it. So, so Josh asks, how do you balance the potentially competing aims of sustainable public debt and fiscal policies? How do you balance the potentially competing aims of sustainable public debt on the one hand, and fiscal policies conducive to business and household confidence on the other? And what I might tack onto that is, I guess, a question about the late Wynne Godley's stock flow consistent monetary economics, sort of the sectoral balance argument that essentially, unless you're running a current account surplus and your domestic private sector is able to accumulate financial assets over time by selling or lending more abroad than it's buying and borrowing from abroad, then in a sort of three-sector disaggregated model of the economy, if your foreign sector is in surplus, aka you've got a current account deficit, and the government is in surplus, aka taxing more liquidity out of the economy than it's spending into the economy, doesn't that imply, as we saw over the Howard surpluses, doesn't that apply a deterioration in private sector balance sheets? Obviously, if you're Norway and you're selling and lending more than you're buying and borrowing from abroad, your domestic private sector has an alternative source of positive cash flow, and the domestic private and public sector can both run surpluses simultaneously. But I guess the Godelian sort of argument is that if you don't have that, if you're running a current account deficit, well, all three sectors of the economy can't be in surplus at once, and therefore the question is, which sector do you want to be in deficit, the private sector or the government sector? It's a bit it's a bit of a simplified model, but I'd be interested in your thoughts there.
Well, I don't subscribe to that way of thinking about the flow of funds, and I refer you to chapter 2 of my book, which I didn't cover at all today, but it gives an alternative way of looking at the flow of funds. And we could talk about this at length privately, but we haven't got time to talk about where I see the flaws in the Godley approach. But look, the other question was about sustainability, was it not? About
the debt sustainability
of the debt,
fiscal policy supports businesses.
Yeah. Well, I mean, debt sustainability ultimately depends on the relationship between the rate of growth in the economy and the effective interest rate paid on the debt. A classic sustainability framework looks at how those two variables are behaving, one relative to another. And I refer listeners to the May issue of the American Economic Review, where this is covered in a couple of papers, particularly instance the paper by Boskin in that issue. But and of course, Olivia Blanchard had said, well, because going forward, R interest rates is going to be less than G, then the debt is sustainable. Well, other authors take issue with that, and I would too, because I cannot see how interest rates can stay as low as they've been with all this public debt being issued. And also G is not going to be strong for a while. So R is going to rise relative to G, which means that work has to be done on reducing public debt. Otherwise, it'll take on a life of its own.
Yeah. Now we are just, we've had one last question's come through, but I am conscious that it's a minute to one. If you've got time for one more question, otherwise we sort of tend to do a sort of question on notice system. Sorry, so Tony, do you have time for one more question?
Oh, yeah, I can take one more question.
Okay,
yep.
Terrific. So the last question is from Benjamin. The Australian government may need to focus more on economic reform to build a strong economy than it will less over-rely on fiscal policy and monetary policy. What's your advice? Massive question, but a great one.
Yeah. Look, the fact is that the loss of employment has occurred largely in the private sector. The public sector has been largely unaffected. So restoration of growth is going to depend upon restoration of employment in the private sector. And critical to that is an increase in investment, private investment, which has been the stick variable in the C plus I plus G plus X minus M equation for the years post GFC. So investment has been anemic. That needs to grow. But also, we shouldn't forget about trade. I mean, we're seeing a reversion to protectionism, which is also a danger. We talk about self-sufficiency, and so on's becoming, very popular term now, self-sufficiency, which means protection, which means less trade. So investment and trade are key to a revival of the economy. And that may well require other than fiscal policy reforms, and as I mentioned in my CIS paper, the need for industrial relations reform and also deregulation of industry.
Sure, terrific. Well, thanks very much. We've ran out of time. Really appreciate it. I'm very keen to finish the book now. If we were doing this live, I'd say, can everyone please join me in giving Tony a round of applause? But I suppose in the interim, if people want to get in touch with you, we've already had a few comments and questions asking where they can get your book. What's the best way they can access your work and get in touch with you?
Oh, you could email me. That's fine.
Don't worry.
Get my email from my Griffith site. Yeah, that's fine. So if there's any questions that I haven't answered, feel free to do that. No problem.
Terrific. Now, thanks very much, Tony. And I think for the moment, we've been doing quite a few of these Young Economists events lately. I think we're taking a bit of a break for the next couple of weeks at least. But we'll be putting out information about our next couple of events in the coming weeks. And thank you very much again, Tony. Cheers.
Thanks for inviting me. Thank you very much.
Thank you.
Bye-bye.
Cheers. Have a good week.